uh, of our services. We will use the raise your hand feature to ask questions at the end of your keynote presentation. If you'd like to post that question, you can send that to Chloe, chloe.diamond@lpl.com. So with that, let me get started today with our preamble, and we'll introduce our special guest, Charles Blank, in a few minutes. As always, this slide shares our background, a little bit about our passion and purpose, as well as, most importantly, our disclosures for you, our audience, today. Our mission and vision, for those of you who are new to our programming, our mission and vision is our foundation for our service to you, our clients, and our colleagues with whom we collaborate with. Certainly, we're grateful for those we serve and for those who have been able to serve by referring our colleagues who are experts in their own arenas, such as estate planning, investment planning, tax planning, and even corporate law, among other areas. We love serving our business owners, our entrepreneurs, our healthcare professionals, and of course, our savvy women community. So with that, let me continue on and just speak to a little bit about, we always talk about your financial house. We have built this graphic, if you will, to kind of parse out and carve out the various areas of the work that we do and the work that we do with our colleagues. And certainly we're happy to offer a lifestyle upgrade assessment at your convenience. Now, I'm going to take a little step back into history before I introduce Charles Blankley, who is going to be our keynote speaker today. I think most of you will be very surprised to see what has happened just in the last 5 months. This was a slide from October 20th on a Friday. Markets were in what I call a fall swoon. This is the S&P 500 that day and year to date. I guess the message in these next couple of slides is to kind of remind us all that it's really time in the market, not trying to time the market. And even our best experts sometimes have a difficult time timing the market. So if you were in the market and you were a little down that, we had such a great year so far, in October 20th through that next week, the market kind of had a little fall swoon. It was at 42,200. Well, today the market sits at about 52.54 with this, according to this slide in this moment. And if I do some quick SUI math, that's about 23.5% round numbers of a gain, if you will, from October 20th to now March 21st, which is exactly 5 months. So had someone decided to sell a position or their entire portfolio, go to cash, whatever, in that time frame in October and not time returning back to the market, they would have been missing out on about 20+% growth. So Charles will add a lot more context and color, to this part of the conversation today. And then let me just add familiarize ourselves with the Dow Jones, which is our 30 largest stocks like Apple, Microsoft, United Healthcare, IBM, and others. So 5 months ago, it was at 33,290 or 33,302, excuse me, year to date at that day. And if you look at what it is today, when we did these slides, updated the slides, it would have had a 19.5% gain. So again, the makeup of each of the indexes are a little different, but you're still talking about, almost a 20% gain in the 30 largest stocks, and then a 23.5% gain in the 500 U.S. stocks. I could have done this forever and gone through all the indices around the world, but in lieu of time here, I want to make sure that we give Charles time to give us the real information about what's going on in the world today. So with that, what I'd like to do is introduce Charles Blankley. He is the Chief Investment Officer at Gimmer Asset Management, a very well-known investment advisory firm based in Walnut Creek, who we partner with. We've been partnering with for a very long time. Charles is one of our very best presenters, has been a guest on CNBC, and as you will see, is a wealth of knowledge about markets, economics, key drivers in today's global financial world. And he has a lot of, I think, very cool comments to make regarding what's happening in 2024. We will take questions at the end of the presentation by using the raise your hand technique. If you have questions you'd like to email before you forget them, you can email them to chloe.diamond@lpl.com. So one, I'd like to thank you all for your time today, and let me turn this over to Charles. Let me just quit sharing.
Great, thanks, Marilyn.
All right.
I think I have my screen up. Hopefully you can all see it. So good afternoon, everybody. Thanks for joining us. I hope you've been well and the new year's treating you well so far. It's hard to believe the quarter is almost over. So what I'm going to do here for the next, 20 minutes, 25 minutes, just talk about where the markets have gone so far this year and give you a sense as to what's been driving the markets. And then rather than telling you where we think things are going to go, I want to talk about 3 different scenarios for the next 12, 18 months. I'll tell you which scenario I think is the most likely, but sort of give you some information for the other scenarios that are possible, and you see a lot of discussion in the news media. And then I'll close on something we all near and dear to all of our hearts, politics. So not necessarily the political race itself, just looking back in history, does politics, do elections impact the markets? And so let's get going. So I've updated this table that we put in our quarterly letter all the time through today. And the basic point is equity markets are having a good quarter. So you can see global equities so far this year are up a little over 7%. S&P is up close to 10. The Russell 2000 is a small cap index. It's lagging large cap, but it's still up. And the international indexes are also positive for the year. So the big story, why the markets have done well this year, is in part due to inflation. So that bottom red box, you can see core inflation continues to slow. So it isn't negative. We don't have deflation, but disinflation, where the rate of change is slowing. And this is inflation in chart form. And so you can see the big spike in inflation during the COVID crisis. And then both of those lines, so one is headline, it has oil and food in it, and the dark blue line is core, if you strip out oil and food. Both of those lines are in a downward trend. So the Fed's goal for inflation is 2%, and we seem to be on the path towards that number, however, albeit relatively slowly the last 3 months. So the market's like that. It means inflation's moving in the right direction, but there's a couple of other pieces why the markets have done well this year. Part of it's the growth outlook. So this shows you economic growth in the United States quarter by quarter. So you can see in the first and second quarter of 22, we actually had negative growth. It wasn't big, but the economy shrank, but we've grown ever since Q3, Q4 of 22, we grew all of last year. So third quarter of last year was a strong quarter, over 4%. We had good growth in the fourth quarter. And the estimates for the first quarter of this year are running, 2% to 2.5%. So a solid growth backdrop. And what that means is corporate earnings are growing. So this is quarter by quarter earnings growth for the S&P 500 companies. So again, you can see we had an earnings recession in late 22, early 23, but we've had 2 quarters of solid growth, and the projections for the coming quarters are pretty solid. And so stocks are up because inflation's down, growth is decent, and earnings are surprising people on the upside, which has all been good for equity prices in general. So what do we see going forward for the next 12, 18, 24 months? So I think there's 3 scenarios that we read a lot about. You probably read a lot about in the media, in the newspapers, online. And I think the most likely scenario is probably more of the same. So I'm calling it a soft landing, but there's 2 other scenarios I'll touch on as well. But I think the key point for the soft landing scenario is that inflation continues to slow. It doesn't mean it's going back to 1%, but I think sort of 2 to 2.25%, 2.5% type inflation numbers is a positive backdrop, right? I think 12 months ago, people were so pessimistic on the inflation outlook that it was going to be 4% plus forevermore. The fact that inflation can move towards 2%, I think, is a positive for the markets, both the stock and the bond markets. The other key component to that soft landing scenario is that consumers continue to spend. And I think that's quite likely. There's the qualitative stuff you and I see all the time. You go out to eat in Walnut Creek or Dublin or wherever you go out to eat. Restaurants are packed, bars are packed, theaters are busy. Consumers still have a lot of cash. And so this chart is just showing you checkable deposits and currencies, a measure of consumer liquidity. It's not at the all-time high, but it's pretty close to it. A lot of consumers, if they have mortgages, have locked mortgages in at 3% thereabouts, so they haven't been impacted by rising mortgage rates. There's definitely some strength in the consumer sector at the lower income levels, but at the top 3 deciles, there's still a lot of cash to be spent. So I think the consumer, which is 3/4 of the economy, continues to do well the next year. And then the controversial piece, it's both positive and a negative, but from a growth perspective, the government's likely to continue to spend money. So this shows you fiscal deficits going back to the 70s. So we had the big blowout in the deficit as a result of COVID. And there's very little chance deficit spending moves dramatically one direction or the other. I mean, obviously, President Biden has a budget out. It's unlikely to pass. It's almost certainly not going to pass. And so I'll touch on the political dynamics at the end of this. But I think bottom line, when it comes to fiscal spending, not a lot's going to change. So there's a lot of money coming out of Washington, particularly in things like, incenting capital expenditures, building out chip plants, alternative energy initiatives. And that money's going to likely be spent over the next 12, 18 months, which should help growth. And then the last piece on the soft landing scenario is just monetary policy. So it's very unlikely the Fed's going to raise interest rates any further from here. There was a Fed meeting announcement yesterday. Chairman Powell was pretty emphatic that, if inflation moves towards 2%, they're likely to cut rates around the middle of the year, going into the second half of the year. There's a lot of debate. Do we get 2 or 3 interest rates cuts? And I think it almost doesn't matter, right? That what matters is the Fed isn't raising interest rates anytime soon. And that the direction for short-term rates should be flat to down over the next 12 months, which will help that soft landing scenario. And so, that's more of the same, which doesn't necessarily drive clicks online or sell newspapers. So we read a lot about the idea that we're on the verge of a recession. We were reading that 12 months, 18 months ago, and you can still find pieces along those lines that we're on the cusp of a recession, the economy is going to crack. And most of those arguments are predicated on the fact that historically, when interest rates, Fed funds rates has gone up this much, we typically see unemployment hook higher, which is one of the definitions of a recession. So the bottom panel shows you the Fed funds rate going back to 1985. And you can see every time we've had a big move higher in the Fed funds rate, we've had rising unemployment. And that hasn't been true this cycle. We haven't seen the unemployment rate move much. There's certainly been layoffs in the economy. We've seen the unemployment rate tick a little bit higher, but we haven't seen a big increase. And I think sort of the post-COVID world is proving to be different. There's still a lot of unfilled positions out there. Businesses are having a hard time finding skilled candidates in a lot of areas. And so we sort of have rolling layoffs, sector by sector. Housing was hit 12 months ago. Construction declines. We saw layoffs in that area, but housing's picking up. The housing starts number this morning was actually very solid. So it's quite likely we see increased employment in the housing sector, for example. So I think the odds of a recession in the next 12 months are pretty low. I'd say, 10%, 15%. The odds much favor that soft landing, continued growth scenario. I think if something goes wrong over the next 12 months, it isn't going to be a recession. It's going to be a resurgence in inflation. And that maybe not within the next 6 to 9, But if you were to look out into 2025 and beyond, I think it's quite possible we see inflation come back. And much of that's related to fiscal policy again. So a way of showing you is on this chart. So this one's a little involved, so I'll walk you through it. So the x-axis shows you the unemployment rate. So 12% at the high end, 2% at the low end. And the y-axis shows you fiscal deficits. And so generally, when the unemployment rate is high, we see large fiscal deficits. And conversely, when unemployment rate is low, we see smaller deficits or even surpluses once in a while, although it's been a long time. And post-COVID is different, right? So in 2020, unemployment was high, obviously, because of COVID, and we ran very large deficits, 15% of GDP. 21 unemployment rates came down a lot. We still ran large deficits. 22 and 23 really stand out because unemployment is unusually low, but we're still running historically very large deficits. And I think if you look out to 2025 and beyond, if this continues, I think that can set the stage for another cycle higher in inflation. So if I had to put a number on it this year, I'd say maybe it's a 1 in 3 probability that inflation comes back. I don't think it's the base case, but it's definitely something we're watching as we move into the end of this year, going into next year. So that'll make a big difference on our bond strategy, how much risk, how much maturity risk we want to take in fixed income. And it could also have big implications for our equity allocation. If inflation comes back, it's quite likely sort of the high growth, high beta, high multiple sectors of the market could be hit. Again, it's not a risk for this year, but something we're watching for next year. I think we got to touch on politics, right? We're in an election year, not only in the United States, but around the world. There's a number of elections. We had one in Taiwan at the beginning of this year. And there's quite a number throughout 2024. And the natural question is, will our election or any of the elections impact the market over the immediate term? So a way of trying to answer this is to think back to the beginning of the decade, right? Every decade has a theme. The 1980s sort of were supply side economics, deregulation, falling interest rates, falling inflation. The 70s was the reverse of that, right? We had the ongoing war in Vietnam, oil shock, inflation, rising interest rates. And the current decade has had its own theme, right? So obviously it started with COVID. We had a very contentious election in November of 2020, the storming the Capitol building soon thereafter. We had 3 additional, at least, waves of COVID in 2020, 21, and 22. Russia invading Ukraine. We had the inflation spike, the Fed raising interest rates. It seems like an age ago when Silicon Valley Bank went under in First Republic, but that's only March of last year. And then obviously Hamas terror attack against Israel in October of last year. So if you were sitting, in January of 2020 saying, what would the market do over this period? You'd probably say equities would be down. But it's actually, so far this decade's been pretty solid. The S&P is up close to 60%, which works out to about a 12% annualized return. And all the other equity indexes are in the black for the decade so far, and only bonds are down. So my point in going through this is oftentimes there's a big disconnect between the headlines and what the market's doing. And if those of you old enough to remember, if you're investing in 68, it was similar. And so 68, probably the most contentious political year in modern US history. So we had the Tet Offensive in Vietnam, right? All the pessimism that we were losing the war. Dr. King was assassinated. Robert Kennedy was assassinated. We had riots, shootings at the Democratic Convention. LBJ decided not to run. Awfully contentious year politically, but the S&P was up close to 8% that year. Again, a situation where the headlines and what happened in the markets didn't seem to correlate at all. And so my arguments and this is very market specific, right? That what goes on politically can have huge social implications, but when it comes to the markets, what really matters is what happens with economic growth, what happens with earnings growth, what happens with inflation and interest rates, right? Those are the four things that really drive the markets over reasonable periods of time. And 1968 was a good year for the markets, in part because those four things were moving in the right direction. We're in the middle of a bull market. The S&P gained basically 50% over a 26-month period. And the economy was growing. It was up almost 10% in 1968. Unemployment fell, personal incomes grew, and we saw strong consumer spending and credit demand. And that's really what happened for the market direction. And so my argument for this year is, politics will have an impact, right? Socially, will have an impact on the Supreme Court. It'll have an impact on social legislation. But what's going to drive the markets this year are going to be those four things. And if you look back throughout history, there's been basically no correlation between the party in power and where the economy has gone. So this is overlaying political parties, presidents, and GDP growth. And so, whether the line is red or blue, we've had fairly consistent GDP growth in the United States. And it's the same when you look at the markets. So this is the S&P 500 over time under different administrations. And again, there's really no correlation. What matters at the end of the day is where's growth going, corporate earnings, inflation, and interest rates. And my take is this year, those four things probably move in the right direction. We continue to see steady growth. Corporate earnings continues to plow ahead. And I think inflation, while it may not fall below 2%, isn't the risk it was 12 months ago, which means the Fed doesn't need to raise interest rates. So that's a relatively benign backdrop for the stock and bond markets. And just circle back to politics one more time. So we've made the case for some time now, and I guess I would stick by this prediction that the ultimate outcome of most election cycles in the United States ends up being gridlock, for better or for worse. And a way of showing this is to show you this chart showing you the number of bills passed by the various Congresses going back to 1989. So the 101st Congress in 89 passed close to 450 bills. So they did 140-ish in the first year and the rest in the second year. So you can see how over 2-year periods, how many bills were passed. The last Congress that that is 1 year into its term was the least productive Congress in modern U.S. history. And I don't think there's anything that comes out of this election cycle that changes this. And if there is something that comes out of the election cycle that does change this, I think we'll have time to react as investment managers, as portfolio managers, right? We need to get through the election, see how the congressional balance falls out. And then we need to see what legislation is proposed, right? So we may see dramatic spending cuts, or we may see dramatic spending increases, right? But I think we have time to react to that. That isn't something that we all need to try and anticipate at this point in time. And so my base case scenario for the next 12 months is really that soft landing scenario where we continue to see growth, inflation continues to drift lower, and the Fed isn't forced into hiking interest rates. And I think that supports stocks and bonds for the next few months. I'm not unduly worried about a recession. I guess my biggest worry is that inflation comes back in 2025, particularly if we see some big legislative changes out of the new administration next year, whichever administration it is. And so I think elections add volatility, but really it's probably incumbent on us to tune the noise out. I know Marilyn talks a lot about, watching the news day to day can drive you nuts, that you should just read the weekly summaries. And I think there's a lot to that, right? Is trying to tune out the noise is harder today than it's ever been, but it's probably more important than it's ever been. And that's basically it. So I'll turn it over to you, Marilyn, if you have any questions.
Thank you, Charles. Here's what we'd like to do. Are there questions from our audience? You can use the raise hand, if you will. And then Chloe, if you have questions that came in an email, we can ask those if you wish.
Actually, yes, we do have a few questions that came in. Firstly, great presentation. Always great to hear you speak, Charles, and always interesting to listen, especially about the market and things that are very foreign to to some of us normal folk. But the first question is, the economy is good for stocks and inflation is going down, but many still feel personal financial pain, and we are just wondering why there's that disconnect.
Yeah, that's a great question and a good observation. Hang on, let me find the chart. So I think there's two pieces to it, right? Is that, when we look at the broad growth numbers, right, this aggregates everybody together, right? And so on a broad basis, the economy is growing. I think when you break it down into income deciles, that people's experiences are dramatically different. People at the top decile own a lot of financial assets that have gone up in value, and they feel good about the economy, and their jobs tend to, not always, but they tend to be relatively stable. I think the further you go down the decile ranking, people own much fewer, if any, financial assets, and they have much more tenuous job positions. And that isn't new, right? That's been the case for a long time, 30 years, 40 years. I just think those extremes become more extreme. And then you add on social media to sort of everything, the news cycle, and those things then get multiplied many times over. And that's a real issue. There's no denying it. From an investment perspective, unfortunately, for better or for worse, it's relatively cold calculating, right, where are corporate earnings going, and job layoffs can make corporations more efficient where you see earnings growth, although it's tough for the people being laid off, right? But as investors, start to react to the earnings growth. So I don't have an easy answer to it, but I think that disparity in wealth, the disparity, in owning financial assets, in job stability, explains a lot of it.
Yeah, very interesting. No, and I definitely think people are feeling that with even just gas prices and cost of groceries now. It's crazy. It's gone up so much. But yeah, thank you for that insight. Kind of going along the lines of politics, we had a question about presidents liking to take credit and also blame for the economy, but it's just not the case. Is the influence really just the politics?
Repeat that last bit. Is the which?
Influence really just the politics? I think the influence of, I guess, the economy in this case.
Yeah, I think the amount of power presidents have over the economy is very slim to none. There is very little influence they can have over their 4-year term to move the economy one way or the other. Somebody who's in office for 8 years may have more influence in that second half if they get the legislation right in the first half. But Clinton, for example, President Clinton taking credit for balancing the budget in the late 90s, he really had very little to do with that, right? It was a bull market in stocks, dramatic increase in capital gains. We had a once-in-a-lifetime tech bubble. It really wasn't his or Congress's achievement. It was sort of a confluence of factors that led to that scenario. And then conversely, I think presidents get blamed for bad economies when they didn't cause anything. So I think they have very little influence. I think Congress and the president set the broad parameters that can drive secular growth trends over long periods. But that tends not to play out over a 4-year presidential cycle.
Very nice. Thank you. And then We have another question is deficit spending at the federal level really any problem at all? And if it is, why is that?
That's a good question. Yes. Okay. So this is the annual budget deficit. And so when you look at total debt outstanding, it's roughly 100% of GDP, which is the biggest it's been in the United States outside of wartime. And to be brutally honest, we're not sure how high that can go before it becomes a problem. There's the Japanese example who has total debt to GDP twice ours, and they have lower interest rates, and it clearly hasn't been a problem in Japan. And there are very few instances of debt levels being a problem in countries that print their own currency. I think the way it plays out in the United States, because we control our own currency, we print our own currency, is that the fallout from rising and high debt levels isn't sort of default and downgrade that we hear about, every 18 months when, certain politicians threaten to shut down the government and Moody's or S&P downgrades the US debt. I think the bigger risk is the incentive for the government to run inflation hot, to debase large debt levels. And, if you had to guess over the next 5-10 years, how do we deal with our total government debt? It isn't we default. It's just that we run inflation hot. So if inflation has been 2%, I think the incentive to run inflation at 3 or 4% increases pretty dramatically when debt levels are high. So that isn't necessarily bad news for stocks, because stocks, there's an earnings component there, right? And so when prices go up, corporations earn more. So stocks can be an inflation hedge. I think it makes it trickier on the fixed income side if inflation is going to run hot over the next 5 to 10 years.
Thank you. And then I guess one of our last questions is going to be, it's a longer one, so bear with me. So Biden wants to raise taxes on the very, very wealthy and big corporations that pay next to nothing. If those pass, how will those impact the overall economy, since they would definitely lower the deficit? And changes in corporate loopholes need Congress. Do you think there's any chance for that? That's a lot.
I don't know. I don't know on the second piece. It's hard to peg the odds of it. I don't think it happens before the election in November. I don't think we're going to pass any significant legislation until we get through the swearing in January next year. And then we have to see what's the breakdown of Congress, who's in charge. And typically, if there's a new president, they typically can pass one big legislative agenda. So if Biden's reelected, is that going to be his focus? Or if former President Trump's elected, the odds of there being sweeping tax change is probably pretty minimal. He's going to want to extend the tax cuts that mature in 2025. So I don't know how to handicap it. I'm still of the view that it's hard for Congress to do anything. I think the division there is just so dramatic that we're not going to see big legislative moves with Congress structured the way it is. Should it happen? That's a harder question that we probably should debate over a beer or something. I don't know that we can solve the deficit through purely higher taxes. I think the numbers are so large, and the taxes would have to go up so much that I'm sure the math doesn't work, right? It's going to be a combination of tax increases. We do something about spending, and the trouble on spending is that so much of it is, Social Security, Medicare. It is mandatory spending. It isn't the discretionary spending, and so I think the likely outcome is more of the same. But I don't have any great insights on that. Marilyn, do you want to
That's a tough question. I think it's yes, we have a deficit problem. We've had one for, as you can see in the chart, for a number of years. I don't think taxing the ultra wealthy, and I get that there's a dichotomy between what corporates pay and the average tax-paying citizen pays, which is, be apparently unfair. It's just not, I'm with Charles. It's not clear. There's not an exact scientific or financial solution to this. We're going to have to figure out how to do this over time. But I feel a little uncomfortable that the deficit keeps growing and growing with no apparent ability to pare it back. And again, depends on again who's in the White House and who's in Congress. Not that they can change a lot, but there will definitely be a temperament one way or the other regarding taxation.
Yeah,
So
definitely.
it doesn't sound like a very good answer, Chloe, and to the audience, but that's our take. Chloe and Charles, I do have a question. We focused a lot on the U.S. market because, one, we're very proud of our market. Corporations here have certainly performed very well since COVID. Charles, can you just comment? We always tell our clients that, we need to have a diversified portfolio with participation in global markets, emerging markets, debt across various sectors, depending on how large the portfolio is. Can you comment and give us any color and context on the EU, perhaps other regions of the world that we might want to be involved in, or we just need to have a small participation there? Your thoughts?
Yeah, so return-wise, you can see on the chart the international index, the EFI, that's Europe and Japan, basically, with Australia, New Zealand, a relatively small piece of that. Obviously, they've lagged over the last 3 and 5 years, right? S&P's up 14.8 over 5 years, the EFI international up 7.1, emerging up 2.5. So the place to be has been U.S. equities. And so is that the place to be for the next 5 years? And I think at the end of the day, it's hard to know. It's hard to guess because you have this situation today where the U.S. markets are so much more expensive than the international markets. And so, if you look at the S&P, it's roughly 20 times earnings, 21 times earnings. You look at the European markets and they're 11. 10 and a half, depends on the country that you're looking at. So at a dramatic discount to the US market. And there's reasons for that. I mean, obviously growth is less. They have their own deficit problems. The war in Ukraine means defense spending in much of Europe is going to go up significantly. They don't have the Magnificent Seven, which has been a big thing the last 5 years, right? The tech industry, although they have it, and there are large successful companies, they're not a big part of the market. Their markets tend to be dominated by big industrial companies and commodity companies. I think what it means for us, right? So at the moment we have some international exposure, we're underweight our benchmark, but I would still argue having some Europe emerging markets does make sense, because these things move in cycles. And so you wouldn't be surprised over the next 5 years that parts of the European market or the European market as a whole could match or beat the US market just because it's that much cheaper. Now, when it happens, how long it lasts is hard to predict. But I think, diversification does make sense, that you're not just betting on, NVIDIA and Microsoft and Google continue to grow their earnings at 30%. And their market cap's getting as large as the US GDP, right? You can't extrapolate a lot of this stuff. So I would still argue diversification makes sense, if only because none of us knows what the future holds. And when you get these valuation extremes, they tend to reverse over longer periods of time.
Thank you. Appreciate it. Other questions from our audience? Chloe, is there anything else before we close off and thank Charles for his time today?
Nope, that is it. Thank you so much for your guys' insight.
So let me just share a screen just to talk about one more thing. Yes, so let me do that and get back to here. Let's see. Did I do this right? Oh, here we go. Sorry. Couple things for our clients and colleagues here. We have also started our live events this year as well. So we have a couple coming up, which I think some of you have signed up for. We work with a number of folks besides our Gemmer Asset Management colleagues here. Robert Silverman is going to join me to co-host the Power of Advanced Estate Planning and Building Your Legacy for Generational Wealth. Robert and I have worked together on a number of clients over the last, I'd say, 3 to 5 years, whether it's pre-planning, post-planning, and of course, he was very helpful to me when my beloved passed away a couple of years ago. So he has a lot of experience, and in addition, holds a California real estate license, which is quite helpful for those of us who are also investors in that arena. So it is a Friday. It is a lunch and learn. It is a live event. It will be on April 12th from 11 to 1 in our offices here at the Bollinger Canyon office. So just get a hold of myself or Chloe and let us know that you'd like to join us, and we'll have a delicious, healthy lunch for you as well. The second piece that we are going to work on again is prepare for what I call a healthier future. As you know, many of our friends and ourselves were healthier, we're living longer, and sometimes there's a need for what is called long-term care. So we'll have another great event there with our colleague Amy Stone from Lincoln Money Guard, and that event will be on Friday, May 17th. Again, same time, same place, with another healthy lunch. And so please feel free to join us, share this with your friends. This is an area that, many of us that have direct experience in caring for a loved one or a family member. And it's something that we should consider in our, if you will, our overall financial house. So I'd ask you to consider it and join us. So before I take off today with our friends and colleagues, Charles, thank you very much for your time today. What an excellent job you've done to share your experience and what's going on in the markets and the economies today. We appreciate your wisdom, and we look forward to seeing you again soon. So thank you all for coming today. And if you have questions, feel free to reach out after this. You can call her or email me, and we'll get right back to you. All right. Have a great rest of your week. Take care, and thanks for joining us.